Welcome to Own the Chaos. The stock market is crazy and chaotic.
And crash. You son
Oh,
of a...
God. Hold on. Pause.
Brad and Fat Man Zoom are here to help you own it.
They were targeting Wall Street when they should have been targeting Capitol Hill. They should have been targeting DC. This is the same thing, and this is what people keep missing.
Taking it to the suits, being relatable and hilarious.
You bought GameStop at 400, didn't you? To the moon, baby. To the moon.
Get ready to own the chaos in 3, 2, 1.
What's up, everybody? Welcome to Own the Chaos. My name is Brad. The stock market is crazy and chaotic, and I made it my mission to help you own it. Bit of a pullback today in the markets overall, but no surprise, right? We had a monster day yesterday and really a monster 2 weeks of trading. And in that 2 weeks, we've seen 2 red days. Today just happens to be one of them. Big whoop. But we'll talk about that today, as well as there has been an indicator, guys, that could be bringing on or forecasting a recession. We're going to talk about that and my thoughts on where I think we stand as far as that's concerned, as well as I know I had mentioned yesterday talking about some of the tax implications or the tax bill that's going to be put through Congress, and my thoughts on taxing unrealized gains, even if it is the ultra rich, coming up today. But first and foremost, before we get into any of that, let me hit everybody up with the starting five. We got Housekeeping. What's up, my man? Jeff Ponica, Jonathan Schreiber, Tracy H., and Savvy Money Show. You guys are our starting five. If you happen to miss out on the starting five, it could be because you did not hit that notification bell. So hit that notification bell, hit the thumbs up, hit the subscribe, all of that good shit to help support the channel. I certainly would appreciate it. And you might show up on the starting five if you actually get there in time. Guys, one other thing before we get started. We have had some really good engagement, some really good response to the Chaos Crew. So I wanted to just hit that up real quick. If you wouldn't mind hitting that join button next to subscribe as well. You get a watch list for me every single day before they go live, or before I go live with our level 3 group. But before the market goes live, you get 5 stocks that I handpick myself. I put all the work in. I give a nice little write-up on all 5 of those stocks, as well as a technical analysis breakdown on stocks that I think you should be watching throughout that day. CrowdStrike has been one in particular that I've been very heavy on. Really, I've put this on multiple times on the list since it was down in the 150s, and it has obviously done extremely well. We came up and tested the 200-day moving average, but this has had a $50, $60 move from when we initially put it on the watch list and really started to go hard in the paint on it. So this is a really clear winner so far on the watch list. We've also had plenty of other ones, guys. If you want to get the entire list on that, make sure you hit the join button next to subscribe. Join the Chaos Crew. We certainly would love to have you. It's $4.99 a month. It literally is hardly any risk to you. I'm not trying to get rich off of anyone, but just want to, if you want to help support the channel and everything you see behind you, the studio, all that good stuff, make sure you join the Chaos Crew. Love to have you guys as part of the community. There's all kinds of other stuff in there as well. We have portfolio reviews. I give trade alerts. You can see my portfolio. You can be in their Discord group. There's so much that you get for a very small amount of money. So Oliver Thorpe says, shout out to the minus starting 5 as well. I like that. How we feeling today, guys? Before we get into what's going on, how we feeling today? I see a lot of people showing up this afternoon. I love it. Give me your thoughts. So before I get into this, I kind of want to get your guys' opinion on your own thoughts on the market moving forward. What's that going to look like for the rest of the year? Are you worried about your stocks, going to shit? How bullish are you? How bearish are you? Let me know in the comments as I'm going through some of the things that I have to bring about for you guys in this indicator that may be forecasting a recession. So has everything to do with the yield curve. And I know a lot of you guys have been asking about this, so I wanted to kind of give my thoughts on it in general. So we have seen for the first time since 2019 the yield curve has inverted. If you guys aren't familiar with this, this is the 2, the 5, the 10, and the 30-year Treasury notes. They're on a nice little slope, right? Typically, you'll see the shorter term Treasury notes that are going to be less than the longer term ones. You're going to pay more interest on a 30-year note than you would a 2-year note. Well, yesterday, for the first time since 2019, and before that, 2006, that curve inverted. So then you had the 2-year that was actually higher than the 10-year for a whopping 18 seconds. It was it was a very very short period of time. And everybody started to lose their mind yesterday on this. And for good reason, right? I mean, look, there's a lot of risks. There's a lot of headwinds that the economy, that the stock market is facing. And this is actually a pretty good indicator of a recession. Usually when we see the yield curve invert, there is, I won't say a high likelihood, but there is a likelihood that we could see an oncoming recession. As I'd mentioned before, the last time we saw this was in 2019, which, hey, listen, guess what happened in 2020? So late 2019, we saw the yield curve invert. 2020 came about, pandemic hit, everything went to shit. Before that, 2006, and we know what happened with that, right? The GFC, the Great Financial Crisis, 2008. And before that, I mean, since 1976, we saw the yield curve invert 10 times. 6 of those times we saw a recession. What I will say to that is that we have barely scratched the surface on this. Right now, the curve is no longer inverted. Like I said, it only lasted around less than a minute. We saw the yield curve invert yesterday. And so, you know, I don't want to take this lightly. I don't think it should be taken lightly. I think that there is a lot of risks involved here with the yield curve inverting and what this actually represents. So, like I said, last 6 out of the 10 dating back since 1976, we have seen the yield curve invert, or I'm sorry, 6 out of the last 10 times since 1976, we saw a recession following that. It usually comes within the next 18, 24 months. But there's some interesting stats here that I kind of wanted to bring about as well when it comes to this. So this is from Ryan Dietrich that I thought was some interesting insight. The last 4 times the 2 10-year yield curve inverted, the S&P averaged up 28.8% before the peak. Ultimate peak was 17.1 months later. The recession started 21 months later. Yes, this is a warning, but it isn't so simple. I retweeted that. So go follow me at Own the Chaos if you guys want to check me out. I put a bunch of stuff up on like this as well. And this one here too. Yield curve inversions can be bullish for stocks. The 2 10-year yield curve inversions, and we look at the dates here, right? December 13th of 88. The bull market peak date was at July 16th of 1990. So we're talking, 18 months, 19 months. 33% return on stocks during that time. Yield curve inverted in 1998, May 26th. And then we saw the dot-com bubble, right? But during that time, in that 22-month period, we saw stocks go up 40%. That was the S&P, went up 40%. And we look at, 2005, we'll call it 2006. I call it 2006, but 12/27/2005, it might as well be 2006. There was 21 months. 24%. You get the picture, right? So could we be headed for a recession? I think there's certainly a likelihood that happens, but this doesn't mean that we can't take advantage of this, right? This doesn't mean that there isn't money to be made here. This is actually potentially a bullish sign. There's also some discrepancies here when it comes to I don't want to say discrepancies, I guess, but there's definitely some interesting things to look at. When we look at the yield inversion and what's happened with it over the last, few decades, and we see that the yield inversion potentially could lead to a recession. While yes, that is true, this time seems a little bit different. And I don't want to, everybody, it's like famous last words, right? Everybody talks about well, this time's a little bit different, but it actually is true, right? I mean, When was the last time we saw yield inversion when we were coming out of a pandemic and we were in the beginning of an expansion? When was the last time we saw the yield invert and we were coming out of a pandemic and in the middle of a war where supply chain issues that we're experiencing right now that have brought upon inflation and some of the other things that you guys know that have created a lot of volatility in the market? Right? Never. That's never happened. So we are definitely in a unique time. Now, what I will say is that obviously we have a lot of headwinds here, right? The Fed's trying to create this soft landing with raising rates as inflation continues to go up. But a lot of people are speculating that inflation, a lot of it has to do with supply chains. And once the supply chain gets itself taken care of, demand will start to pull back a little bit, or at least supply will be able to keep up with that demand, which should bring down inflation. And, if you're raising rates while that inflation is coming down, it may not be such a soft landing. So that could bring upon a recession. The Fed could very well do that. And that, if that's supposed to happen, if that does happen, that's going to take probably around 18 to 24 months. I don't think that happens this year. So there's obviously that. Then you have the Ukraine-Russia situation. If that does escalate, we've heard some really positive talks coming out of that. But if that does escalate, obviously that could bring about a recession, even a crash. And I think that, so there is risks out here, right? But I think that there's a lot to actually be excited about. When you look at some of those numbers, when the yield inverts like that, it actually means bullish. It actually means that we could see some bullish movement in stocks. I mean, at least for the short term, I don't know what happens in 23. I don't know what happens in 24. Well, what I do know is that history has shown that over the last few decades, 4 decades, the yield inversion has brought about some pretty decent gains leading up to a recession, right? So I don't think that this is, to me, I don't see how this is a reason to just yank all my money out when I know that there's potentially money to be made. And we look at the economy, we look at the strength of the consumer, we look at the liquidity that's out there for people to spend money, and the savings rate that's going on right now is around 12%. We saw that in January's numbers. So I think that there's a lot to be excited about, a lot to feel bullish about in the market here right now. I just wanted to point something else out to you guys as well. We take a look at one more little tidbit of information here. The S&P 500 is up 11% in 11 days. The only other times it gained at least 10.5% recently was in November 2020, if you guys recall what happened there. We saw a really huge sell-off in tech before the election. The election happened, and we saw a giant rip. April 2020, everybody kind of knows what happened there. October 2011, and then July 2009, March 2009. So, these weren't necessarily times to get overly bearish, says Ryan Dietrich, which is very, very true. If you go back and look at the charts during those times, the market's absolutely ripped face. And I think that while you can make the argument that maybe we haven't seen the bottom, and I think that's very much an argument that could be made, there's some really compelling things here to be very bullish on. And there's still a lot of loud bears out there that are giving you plenty of reasons to be fearful right now. And I think that those are valid. But there's also, you're looking at the 2 and the 10-year yield, and there's also the real yield that exists out there as well. So Tom Lee Fund Strat, you guys know I'm a huge fan. I hope one day he actually gets to see my content, and I hope he doesn't have nasty things to say about it. But you have the nominal yield, right? The 2 to 10-year government bond yield, and the 2-year 2.37%, 2.38% is the 2 years. This is from Tom Lee. Inflation futures market right now, 4.9% and 3% respectively. So 4.9% for the 2-year, 10-year is at 3% for inflation futures. That brings a negative rate, a negative yield, which actually is bullish for stocks. And he also goes on to state that negative rates brought on some really serious bull markets. We look at the last several times this has happened. 26% of the time, real rates are negative, and it's actually more common than people realize. So 26% of the time since the stock market's been in its history. 26% of the time, real rates have been negative. Last a couple of times where the real rates have been negative, 1906 to 1910 were the post 1907 bank runs. If any of you guys have been alive by then, were alive back then, you might remember that. I know a few of you who are that old. The roaring 20s, right? 1917 to 1928. Treasury yields were negative. And so we also look at 1942 to 1958, post World War II economic boom. So these are all very common things that we're seeing, right? So while you're looking at the nominal rates, and yes, there is a yield inversion there, the real rates are still negative. And this could actually be bullish for stocks. So again, you know, this yield the 2 to 10 year yield inverting could be, you know, a sign of things to come as far as recession's concerned. And I don't want to take anything away from that. However, there are some things that are very compelling here that do indicate that there's some differences between what's going on right now and what's happened in the past when the yield has inverted. And so the real rates is really what's got me, you know, kind of excited about what's going on in the market overall. And so that's something that I think, here's the other thing too. Yes, the yield inverted. Let me show you another chart here. Yes, the yield inverted. Look how long it lasted, right? The last time we saw yields invert like this, it was for several trading days, right? It was for an extended period of time. And that isn't to say that it can't come back down and retest these levels and maybe hang out down there, which then there may be some cause for concern here. But right now, we're talking less than a minute the yield was inverted yesterday. So, you know, I think that this is definitely something that you should pay attention to. There's a lot of people out there in the headlines that are talking about, you know, impending doom, and there's a lot of very smart people. Analysts, Bank of America came out with some information yesterday about how there's a lot of institutions out there that are taking a defensive stance. I mean, we're looking at a lot of the defensive stocks as well that have moved up. I'll just give you an example of this. Right. So let me show you some of the defensive plays. One of them is the healthcare sector, United Healthcare, UNH. This is a result of being, you know, institutions being defensive. Getting into healthcare is a good defensive play. We see a recession. It's one of those good stocks to just kind of park your money and wait it out. We look at some of the REITs, for example, KIM, Real Estate Investment Trust, is also a good one, or a good sector to really kind of get into. And we're starting to see this really move up. This is about to test all-time highs yet again. I actually put this on the watch list for our Chaos Crew members this morning as well. So make sure you keep an eye on that. But some of the other real estate investment trusts as well are moving up. Having actually a pretty good day. Maine as well, having a pretty, Maine's working its way back up. We'll see if this actually breaks out. I thought Maine was on the move, but I stand corrected on that. So you get what I'm saying, though. I think that we're starting to see some of these defensive moves made by institutions. But I think when you see this actually is bullish, in my opinion, because there's just too much negativity. There's too much doom and gloom out there that I think that there's going to be some really good opportunities. And for growth stocks in general, I think growth stocks are going to do extremely well, which leads me to my next comments. And before I get into that, my next comments are going to be on where do we go next? What is going to be good, solid companies to get into if we are going to see this crazy move up, right? If history repeats itself, and it doesn't always, but if history repeats itself, and we see this explosive move to the upside the second half of this year, especially if, like I said, if history repeats itself, there are going to be good stocks to get into that I think will far and beyond outperform the market. They've already started to move, but I think there's plenty of room for them to continue to move up. And I'm going to give you guys an idea of where I'm headed in just a few minutes. But I wanted to check in with you guys and see where your heads are at. I like this. The yield curve is not an indicator of a recession. Correct. I think that is one of those things where you look at it and there's usually some sort of correlation, right? That's why people look at it. But again, 6 out of the last 10 times we saw the yield invert, we saw a recession. So that's not really all that reliable, right? I mean, we're talking 60-40, a 60% chance if history repeats itself. I don't think that's that reliable. It's not any like, would you want to take a 60% chance on your life savings? No, I don't think so. You want a much better read on it than that. 30 to 90 day delinquency rate on mortgages is at a 14-year low. That's it's expected to rise, but that's pretty damn good. This time is different, says Chris Edwards. That's what the Orioles said last 18 years. Somebody knows I have my Orioles gear on. I know. Yeah. I got you. The Fed probably won't tighten as much heading into recession. This is bullish for stocks. Yeah, I think so. And I've said that since the beginning of the year. I thought that the Fed was going to tighten up, but I don't think they're going to tighten up that as much as, there's speculation out there around 7 rate hikes, and I just don't know if I see that. I would be surprised if we even saw a 0.5 point rate hike. I know there's a lot of speculation about that right now. I guess it wouldn't shock me, but I also would be a bit taken aback, I guess, if we just saw a 0.5 point rate hike out of nowhere. Say it takes 18 months for seeing the impact of a real recession, says Z Writer. Yeah, that's exactly what we were alluding to. But in that 18 months, we actually see a massive move up historically. Not to say that that's going to happen this time around, but that is also something that history has shown. Oliver Thorpe says, do you think these days that fear overtakes everything? So what we might now see is recession fear, and that we have another sell-off because everyone tried to time the market. No, I think that there is actually an argument to be made that we already saw the bottom, and that stocks have already priced this in, right? Let's look at the SPY. Yes. Oh, no, that's not the SPY. S&P 500 already priced a lot of this in. We go back to February 24th. That was the day of the Ukraine invasion. I wish I had an accurate number here. It was a large percentage of the S&P that was down more than 50%. No, I'm sorry, more than 20%. It was a large percentage. I want to say it was 60% of the S&P 500 was 20% in the red from its highs or more. And you look at the Qs, and it was even worse than that, right? So a lot of this was already priced in. The rate hikes were already priced in. Fears of recession were already priced in. There was just a lot that was already sold off. I mean, how many of your favorite stocks were already down 80-90% at the bottom here? So we're expecting that go down even more. I mean, I guess it's possible for sure, but is it likely? I don't think so. I think a lot of that's because it's already priced in. The Qs actually look very interesting. We're sitting right here around the 200-day moving average. So this is the NASDAQ 100. That's very interesting. And then you see the SPY that's actually holding right at this support here. So this is also a interesting number. I was waiting to see if the SPY actually fell below this 457 mark, because we saw this it as a resistance back in February, beginning of February, and then towards the middle of February, and obviously we saw a massive drop off, and that's when Ukraine came in, Russia came in and started invading Ukraine, and that was just a really big mess. But then we saw obviously how much this has moved up, and then yesterday we gapped up over this resistance, which I thought was very interesting and could be telling for another move up. Today we took a little bit of a back seat, no big deal, because we've seen green days since March 14th. We've only had, this is our second red day that we've seen since March 14th. That's incredible. And it actually held above that 457 mark. So I'm really encouraged by this move as well. We didn't see a breakdown. So no technical breakdowns here that I'm actually really all that concerned with. You look at the IWM, and the IWM took one of the bigger hits today, but it's at an inflection point here as well. I think that this is an important area. This is at 211, 212 resistance there. We span this out, and you can kind of see where I got that from. as far as the resistance is concerned. So we break up above that, I think that we'll be in good shape on the small caps as well. Here's another thing. We look at the VIX, and it's still below. Oops. We look at the VIX, still below 20. We saw a little bit of a move up today, but it was down at 18. I mean, this is volatility index. This to me still screams bullish for stocks. One final thing I'll say on this. If you want the best hedge against inflation and you think that staying in cash is the better idea, I got news for you. And being in bonds is a better idea also isn't good for you. Like, we're seeing real negative rates. Hanging out in bonds is only going to lose you money. So what other place do you have to put your money in right now? It's stocks. And so what's a good place to put your money as far as stocks are concerned? Now, again, this isn't me giving you financial advice, but this is what I'm doing, and I'm actively doing this in my Chaos Crew portfolio. So if you guys want to check that out, make sure you hit the join button next to subscribe. We'd love to have you guys as a part of the Chaos Crew. That we get access to the Discord group, but also every morning I put out a list of 5 stocks that I think are worth keeping an eye on in the market. It could be earnings related or what have you, but I give a really nice fundamental breakdown as well as a technical breakdown of each of those 5 stocks before the market opens. So if you guys want to join the Chaos Crew, we'd love to have you guys over there. It's $4.99 a month. You can't beat that. So not like 20 grand like some people charge. Jeremy Lafufu. But yeah, anyways, so where do we go? Historically, in times like these, believe it or not, it's the FANG stocks. And we're already starting to see that a little bit. Let's take a look at Amazon right now. Amazon's had a huge move. Huge move. It's come back down and tested this support here over the last couple of days, really kind of hanging out at the 200-day moving average at 3,300. But this has had a massive move from its $2,600 low that took place back in the beginning of March, and it's had a massive move up. We look at Apple, right? Apple is threatening to go back up to the $3 trillion market cap. We saw it almost get there back in January of this year. And there is the possibility that this happens as well. Growth stocks in general, large cap growth stocks, particularly in tech, have historically moved really well during times like this. And in a rising rate environment where you don't have to rely on borrowing money to continue your growth, Apple's the best one, literally the best one. They have more cash on hand than anybody, literally anybody. So they don't need to borrow money, right? And so this is definitely a great stock to hold, in my opinion, to be in a rising rate environment. In times where there could be some fears revolving around recession, I think that this would be one to actually continue to hold on to. Now, when a recession happens and the stock market actually rolls over and corrects, obviously everything's going to come down, including Apple. But leading up to it, if we do experience a recession, this is probably going to have monstrous moves. And even in 2019 and 2020, we saw the returns that Apple had in 2020, right? It was up 80%. So absolutely insane moves from Apple. And I think that this, even if it dips down, obviously we talk about just owning Apple, but this is going to be one to continue to hang on to as well. And we look at even Meta Platforms has made a really amazing comeback. We're actually starting to test that 50-day moving average, which it looks like it tried to test it today, didn't quite get back over there. But this is the cheapest of all the FANG stocks. As a forward PE of 18 times next year's earnings. You compare that to the next highest bidder, and that's Google or Alphabet. That has a forward PE of 24, almost 25 times. So Facebook is the cheapest of the FANGs when you look at the fundamentals. But speaking of Alphabet, this is also another strong mover. And this is actually still very cheap compared to the growth that they're experiencing as well. I'm personally in Facebook, and I'm also in Microsoft. Microsoft has kind of lagged the other ones. Microsoft hasn't had the same type of move as some of the other ones have, but this is an extremely good stock. It's an extremely good company. I think it speaks for itself. I don't really need to say anything about it, but I think that this is actually one that I would continue to go on to. So those are the growth stocks in this environment, right? But there's also energy. You've heard me talk about this. This is the OIH, the ETF for the oil services. We got Schlumberger, Halliburton, and we know what oil's doing right now. We know how energy is being treated. This isn't going away anytime soon. I think, in my opinion, we look at energy as a whole, and even if Ukraine, Russia have peace talks and the war ends tomorrow, sanctions aren't going away. There's going to be a lot of companies out there, or a lot of countries. Sorry, I say companies. A lot of countries out there that are not going, including the U.S., that aren't going to just lift their sanctions just because the war is over. That they're going to remain in place, and as long as they do, then oil is still going to, the oil supply issue is going to be a problem. And this is actually, one that I think that would probably be worth taking a look at. We take a look at the monthly chart on this, and actually, let's go to the weekly. It's going to look a little bit better. Last time oil was anywhere near these levels, we saw it back in 2016, and then the OIH was hanging out at $700. OIH was hanging out at $700. When we go back to 2014, forget about it, $1,100. Now, this isn't to say the OIH is going right back to those areas, but you can make the argument about how undervalued this is, and how there's just a severe lack of participation in the space. Even still, even with the moves that we've seen in some of the other stocks, like the XLE, this is another ETF. You have ExxonMobil, Chevron, Marathon Oil, you name it, they're all in here. This had a massive breakout on this ascending channel, and I think that the energy stocks are still going to rock and roll. There's just no way for me to find a bear case right now in oil because of the supply problems that we're experiencing. Demand is still coming back like crazy, and we're about to go into the summer months where there's going to be a wild amount of travel going on because of the pandemic, and there's no resolution for supply letting up at this point. So as long as that remains, I don't see why oil doesn't go to 150 a barrel at this point. Before the war, I was calling for $100 oil. Now that we're taking away 10% of the global supply of oil with Russia, and look, Russia's going to find ways to get it out there, but it's not going to be like it was. I think $150 oil is certainly on the table. So energy stocks are still going to be ones to own. And I think the large cap growth stocks like your Apples, Google's, Amazons, I know that they're all boring, but I'm telling you, they're going to outperform the market. I think that's going to be a real thing. And they already are. So, Alpish, welcome to the Chaos Crew. Thanks so much. I appreciate you. Thanks for joining the Chaos Crew. Again, guys, if you want to become part of the crew, hit that join button next to subscribe. We'd love to have you guys there. All right, just checking back in on some of the other comments here. Some people think the recession is going to happen after this bull run. Blessings seems to think that we already crashed. I wouldn't make that argument. Correct? Did we correct? Absolutely, we corrected. Did we crash? Nah. Somebody been watching Meet Kevin too long. Oh man. Z Rider likes microchips or semiconductors, energy, metals. Yeah, I think that's as long as energy goes up, commodities are going to continue to go up. So you guys know that I like Cleveland Cliffs, some of the other materials plays. Real estate's considered a hedge. I think that real estate's a little bit touch and go right now, especially with the rising mortgage rates. I mean, we're seeing close to 5% mortgage rate right now. I don't know if there's anybody that wants to have a mortgage a house for 5%. Like, that's just wild to me. Anyways, I feel like the past 2 years have made an argument to be in stocks no matter what's going on. High inflation is supposed to be bad for stocks because rate hikes. Now high inflation is good for stocks. High inflation is good for certain stocks, and I think that there's a clear delineation, right? And we've talked about this. Owning stocks that are reporting losses are not good stocks to own during times of inflation. Stocks that have companies that have pricing power. We've talked about how Apple has pricing power. We've talked about how Nvidia, AMD, they all have pricing power. Even right now, at least for the time being, companies like Ford, Tesla, they're still able to pass on the cost to the consumer. And until we see a destruction of demand, I think it's all systems go. So even in times of inflation, there is good stocks to own, and even really kind of holding on to those dividend aristocrats that we don't talk a whole lot about, but those energy stocks. ExxonMobil has a ridiculous dividend yield, so great stocks to own during times of inflation. So yeah, there is good stocks to own. It's just important to know which ones that you should be hanging on to. It's not just throwing a dart and being like, yeah, let's hold on to that because inflation's here. It's going to be really important for that. Joseph also says, are we supposed to be buying financials for the rate hikes? Yes, I think that Bank of America has taken a back seat. There's been a lot of, back and forth on financials right now. I actually like Bank of America. I think it's actually been doing really well, all things considered. It obviously took a back seat because of sanctions, and some of the financials have been burned because of that. But I think this gives it an opportunity. Yes, in a rising rate environment, when we see inflation go up, yes, Bank of America, your JP Morgans, Morgan Stanleys, those are all going to be good ones to hang on to. I like Bank of America the best. I think that PNC is also going to be, you look at some of the regional banks. I like PNC here as well. So yes, I think that the financials are going to be worth hanging on to. Absolutely. That's instant money in their pockets when rates go up, by the way. Instant money in their pockets. Oh, we haven't talked about this yet, but Blade Runner, what's up, by the way, my man? Good to see you hanging out in the chat. I'm going out on my ordinary and saying Bitcoin. Bitcoin is going to be a good place for savings. That is very, very interesting that you say that, because I, my friend, agree with you. I think this is going to be something that there's a lot of arguments that you can make as to why. Let's go back to the daily chart here on Bitcoin. And we're at a very interesting point here for Bitcoin as well. But there's a lot of reasons why Bitcoin could be good to hang on to, with a lot of the uncertainties of the value of the dollar, right? And we've talked about how the weaponization of the dollar has certainly made a compelling argument for cryptocurrency, and Bitcoin is certainly in that conversation. A hedge against inflation, as some people don't want to make that argument. It actually is, just not in the way that most people think about. And there's definitely other countries other than the US that are considering other forms of currency because of the weaponization of the dollar. So that is another bullish case for something like Bitcoin. And I think if you look at the way that this is actually shaping up, we could potentially be seeing a cup and handle pattern here on Bitcoin. The 200-day moving average has been an interesting point of emphasis on Bitcoin in general. We're sitting at 48K, which is a pretty tough resistance for it. It kind of got rejected today, so we'll see how it reacts. I think that we see a pullback maybe to around 46K. I don't think there's anything to worry about there. It's had a monster run over the last several weeks, and I'm okay if it decides to pull back here a little bit. But yeah, I like the Bitcoin play. I like that a lot. I'm not going to say that I hate that at all. Hey, what's up, Don from the Don Fron Show? Go follow Don from Don Fron Show if you guys are looking to get some good options action and all kinds of other stuff. But what's up, man? Savvy Money Show says, I like Walmart for a recession hedge. If a recession doesn't come, it's good value. If it does, everyone shops in their pajamas and Crocs. It's a very interesting point that you bring up, Savvy Money Show, because the big box stores are definitely something to consider. Look at Costco right now. Costco hit all-time highs today. It's another good defensive stock. It's another good defensive stock to be in if you are anticipating a recession. But it also is great anytime. Costco is on absolute fire. All-time highs today for Costco. But yeah, Walmart has been in a bit of a tough spot. Growth has been a real challenge for them, and then they've had other supply chain problems and what have you. It's still this is waste management. Walmart is still going to be one that'll be worth hanging on to. You can see obviously it's had some pretty strong moves. It's another good defensive stock, 100%. I actually prefer Costco over this one, but look, there's another one that I think that people don't really talk enough about, and it's Target. Target's actually lagged on this move on the big box stores. So I think the value here is certainly in Target. I think you have a lot more upside in something like Target over a Walmart and even a Costco at this point. Absolutely agree. Just going back to the Bitcoin conversation, Blade Runner says Bitcoin is the only crypto that has untouchable blockchain. It can't be molested, for sure. Another great reason to like it. All right. So enough on the market talk as far as the yield curve is concerned. I think that I beat the yield curve to death. Hopefully you guys have a better understanding of that. If there was something that you kept wondering about, I had a lot of people ask me questions about it. And so I wanted to kind of clear the air on my thoughts and where I thought we were headed in some of the scenarios in which we could see play out in the months and years ahead of experiencing a yield inversion. Bottom line is that I don't think that we're going to see a recession out of this when we saw the yield curve invert for a whole 30 seconds. Probably wasn't even in that. Now, we start to see a more steepening of an inversion, then we're having a bit of a different conversation. But for right now, I remain bullish on stocks for a lot of the reasons that I laid out. And I don't think that this inversion yet is something that I necessarily would be all that concerned with as far as the recession's concerned. There's a lot of headwinds out there. There's a lot of reasons why we could go into a recession. I'm just not sure that we're headed for that in that direction just yet. So cautiously optimistic, I think, is the two key words that I would say as far as that's concerned. Now, just one more thing that I wanted to touch on, and this is always a sensitive subject, but the White House actually put out this is something that would be very bearish for stocks as well. The White House just put out a tax plan to tax the ultra rich. So the tax hikes on the wealthy. Just reading from Barron's, more than a dozen tax changes, also including significant changes to wealth transfer rules and increase the corporate tax rate to 28% from 21%. Revenue raisers in Biden's proposed $5.8 trillion 2023 budget, amounting to what would be the biggest tax increase on record. And this all sounds good on the surface, right? Where you see the ultra rich just paying more money to increase tax revenue so that the U.S. government can blow it on whatever the fuck they want to blow it on. And this goes, it doesn't matter if you're Republican or Democrat, they all just blow it on whatever they want. So I really don't want to take a partisan approach to this. Okay. They're all guilty. So, the thing that really stuck out to me was the unrealized gains part of this. And this is what I really am concerned about. And so, this again, according to Barron's, at the 20% minimum, and this is for people who have a household net worth of more than $100 million. 20% minimum tax would apply annually to combined income in both liquid and illiquid unrealized gains on taxpayers whose household net worth is more than $100 million. As I said before, this means gains embedded in anything from a stock portfolio to fine art collection will be included in the equation to determine a 20% minimum tax has been met. This is referred to as a billionaire's tax because more than half of its revenue would come from billionaires. The tax is aimed at wealth that could potentially remain unrealized and untaxed during a taxpayer's lifetime and beyond. Under current law, gains are taxed only after the sale of an investment when gains are realized, which is how it should be. This tax is meant to address fairness issues, says Garrett Watson, a senior tax analyst at the Tax Foundation. There are situations in which people amass wealth that never gets taxed. They can simply borrow on those assets when need to, then address that problem. Don't tax unrealized gains. I don't think that the government or anybody, whoever drew up this bill, understands the implication that it's going to have on us little people and the way that we invest. And it's going to disincentivize these billionaires, the ones that actually move markets, to invest in the U.S. And so for me, I think that this is a bear case for the market. If something like this goes through, that is going to be bad, not just for billionaires, but for everybody else underneath of them in the tax bracket. Okay. We're not talking about as human beings, but in the tax bracket, everybody below them is also going to suffer, because if Mark Zuckerberg or Elon Musk, after he's already paid record tax money or a record amount of taxes to the government, willingly, by the way, Jeff Bezos, you name it. They all say, I'm out of here. We're not dealing with more taxes on taxes on taxes. That's going to crash markets. Plain and simple. You're going to take liquidity out of the U.S. market, and they're going to go to something, I don't know, emerging markets, whatever. I think that is very dangerous stuff. It also is just extremely un-American. These are set up to build wealth, right? We want people to make a lot of money in America, period. And so address the issues that actually need to be addressed. Okay. If they're jumping through loopholes because they're borrowing money against their investments, then attack that part of it. Don't just go after unrealized gains, because it's going to get super messy and it's going to trickle down to the rest of us. So if that goes through, then we are up shit's creek without a paddle. I think that's going to be very bad for stocks, as well as this 28% tax increase. So we're going to go from 21% to 28% increase in taxes on corporations. That's going to affect their bottom line, right? So earnings are going to come down. The stock market's going to come down. So all of this is bad for the market. Bad, terrible. So the question is, does it go through? I don't think there's a chance in hell this happens. If I'm honest, I don't think there's a chance in hell. I think there's Democrats and Republicans on both sides of the aisle that are like, fuck this. There's no way this is happening. And you know, it is, I think it's political suicide if this actually goes through, and anybody actually votes yes on this, period. So there's too many bad things that could happen as far as this tax plan is concerned on the ultra rich. And if it does go through, we're in for a world of hurt. If it doesn't, then it's all systems go. We're going to be fine. And I think the latter is going to take place. So is there cause for concern? Yes. But most of this, I'm just shaking my head at, and I'm thinking to myself, there's not a shot in hell this is happening. So still, again, nothing that I think that it would be necessarily anything to worry about on that front as well. Don Front says, easy on the borrowing against. That's not a loophole. That's just knowing money. Yeah. Listen, still following the law. You're not breaking any laws by doing that. This is my fear. The ultra rich will move offshore and exempt themselves from U.S. tax liability. Yeah. So there's the value fluctuates at any moment. You're better off tax. That's the other thing too. So like, that's what makes it so confusing. So there's in this plan, like for example, Mark Zuckerberg is red on the year, right? His unrealized gains are in the shitter. So the government will give you a credit for that. And then it goes back up. And then I guess you pay taxes once you start making money again. So it's just so confusing. And there's just, I don't know, there's much easier, much better ways to go about doing this. If this is really what you want to go after, this ain't the way to do it. And it ain't going to happen. All right, guys, great stuff today. I hope you enjoyed today's show. Obviously there wasn't any, earnings to really kind of go over that were worth talking about. So I decided to just go over this. I was actually going to make this a pre-recorded video going over a lot of this information, but I thought there was so much good stuff to talk about and chat about that it was going to be a good conversation on a live stream, since we didn't have a whole lot going on as far as earnings are concerned. Tomorrow is also the same problem. There's no earnings to be talking about, but there might be a chance that I do not actually go live tomorrow. One of the big reasons is because I'm going out of town. I'm actually going to see Peter Saddington down in Charlotte. So I'm going to be flying down there tomorrow morning. Going to be hanging out with him and seeing what he's got going on. And he's got some really good stuff to share with me that I hope that I can bring back to you and let you guys know what's going on down there as well. It's got some really special stuff going on. So tentative for tomorrow's stream, but I will try to make it, and we'll talk about whatever's going on in the market tomorrow afternoon. That's going to do it for me, guys. Thanks so much for tuning in. Hit that thumbs up if you enjoyed today's stream. I threw a lot at you, so I definitely am looking forward to the comments later on tonight on some of the feedback. But again, hit that subscribe button, hit the notification bell, hit that like button on your way out the door. And one more time, hit the join button next to subscribe as well to get my watch list. Every day I put out a watch list of 5 stocks before the market opens. I give good fundamental analysis as well as in-depth technical analysis on all of those stocks and why I think that they're going to be worth watching throughout that day to day. throughout that day. And guys, it just supports the channel. It's $4.99 a month. You can't beat it. You get access to all kinds of other stuff. My portfolio, trade alerts, portfolio reviews. You get all kinds of stuff. Access to our Discord group. $4.99 a month starting out at. So thanks so much for tuning in. I hope you guys join the crew. And that's going to do it for me. Bye.